All right, folks, Greg Freeman here from Freeman CPA. Today's segment is brought to you by Freeman CPA and Atlanta Business Accountants, where your success is always our success. All right, so I just wanted to pick things up where we last left off. And when we were discussing real estate, rental, and how to claim losses, remember that when you're dealing with rental real estate, you typically create passive losses for tax purposes because rental real estate is deemed basically passive by default. So if we're trying to obtain as many losses as we can only use those losses to offset other passive income. And that seems to be where most people get trapped, is that they don't qualify to receive the passive losses unless there's an exception. So that exception was, as we spoke last time, is the mom and pop exclusion. And unfortunately, I was in the haste and typing up a few things here, but I have to remove this if you, so the mom and pop exclusion of $25,000 applies to you if you are also an active participant in the activity. So obviously, you need to still meet the income qualifications and you have to be actively participating. And we'll discuss how real estate ties into all that. So again, two major exceptions, right? You have the mom and pop exclusion, which allows for up to $25,000 to be deducted from your other active income, or you can be a real estate professional with material participation. That's really how it should have been written out. And unfortunately, I was in such a haste that I didn't put those two together. And when I was already presenting, it just kind of read right through. So I just wanted to get that straight for everybody so that there's no confusion. So let's talk a little bit about exactly that mom and pop exclusion and the active participation. So here's a good example, and we'll just run through what we have, right? So remember we had those three scenarios, right? So your average scenario is the one that we're typically referring to, and that's when you have, a pretty decent setup because the property is producing positive cash flows for you, right? So you're actually pocketing money. It was a good deal. But for tax purposes, because of the depreciation, you're shielding any taxation, okay? And so you're producing tax losses or paper losses and receiving tax benefits on your return if you have active participation in the rental real estate, and if it's not over $25,000 and your income is not greater than that 150,000 Maggie cap, all right? And remember, it starts to phase out as well. So it's not that you reach 150 and then it's blank. There's actually a phase out. And remember what a phase out is. So once your income is starting, and when I say income, I mean the Maggie, the modified adjusted gross income. So once it starts going over $100,000 and we're getting to that $150,000 mark, it starts decreasing little by little as we get closer to that 150 goal. Once we get to that 150, anything above that, it's automatically zero. But everything in between is just basically reducing that $25,000 loss little by little until you get zip. All right, so that's where this comes in. Okay, so why don't we look at a quick example, and then maybe this can help clarify things for everyone. Let's define active participation. And active participation is it's less stringent than material participation. So just about anybody that gets into the business of renting real estate is going to qualify. And you have the definitions here on this tab. So to qualify, you simply need to own at least 10% of the rental and have substantial involvement in managing the rental. So that's going to be just about everybody. And by the way, if you have an agent that's managing it for you, that's an extension of you. So that would qualify as active participation. And basically, management activity is just, approving tenants, approving repairs, maybe doing the repairs yourself, whatever. The accounting, hiring the accountant, keeping track of numbers, opening bank accounts, so administrative work and keeping the money in a security deposit that's bearing interest and so on and so forth. So that's basically what active participation is for the bullet point one. You're not a limited partner. And again, limited partner is somebody that's their involvement is limited, so they're not very active, okay? I don't want you to get confused with active participation because it sort of is the right term here. But, when we think of partnerships and partnership taxation, we really deal with two types of partners, and it's general partner and limited partner. And general partner really is what I mean when I say active. All right, that won't apply to many people. If we're dealing with like your basic mom and pop situation, you go out with your spouse and you're basically investing in a rental property, and that's going to be your rental property where you have, a year-to-year tenant situation. This is all you really have to worry about, right? Is that very first bullet point. And limited partner really deals with partnerships. So a very classic example of a limited partner in a rental real estate can be like one of my older clients that I've had for many years until she retired out of it, where she had her son-in-law was basically wealthy and he put up all the money and she would manage the properties. He had absolutely zero say in anything. He literally was just, the investor, and he put in a few $1,000,000, and she went out, picked out the right properties because she knew the rental real estate market very well and knew exactly where to buy things and the timing and renting it and managing it and then eventually selling it. And so she did all of that grunt work, and he basically just put up the money. And that's a classic example of a general partner and a limited partner, somebody that's very hands-off and just is merely more of an investor than anything else. Then you have the person that's putting in the sweat equity, if you will. All right, so you're not a limited partner, so most people it won't apply. And then the third bullet point, the amount of loss eligible for 25,000 allowance is determined by netting income and losses from all other rental real estate activities in which you actively participate. So that just means that you got to sum everything up and you're netting everything. So if you have more than one property, you're just basically netting it more. All right, so that's the active participation part. So why don't we take it for a spin and look at an actual example? So here's your basic mom and pop. You have somebody goes out, buys a rental property, and that rental property is generating a tax loss. So we are going to say, I don't know, $30,000. Okay. So it generated a tax loss of $30,000. And then there's active income from a W-2. And that active income was $100,000. So now we're really interested in getting as much of this, deducted as possible. So if we're looking to deduct $30,000 as a regular couple, I wouldn't be able to do this because even though my income is below or right at where it starts to phase out, remember from 100K, and when I say income, let's just assume it's Maggie, the modified adjusted gross income, okay? So if we're looking at your active income from 100,000, and we can just shortcut it and say that's the Maggie as well. And there's really not a big difference between Maggie and regular income. But just for simplicity here, let's just go ahead and say that that's your Maggie instead of active income. And so now you're at 100,000 with this W-2, and you want to get 30,000. So you're not a real estate professional. So how much will you be able to deduct? Well, if you said 25,000, you're correct. So since it's $25,000, and that's all we can claim, $5,000 would be disallowed, right? And so we have $5,000. So this would be this allowed portion. And it would carry forward indefinitely on Form 8852, all right? And that's basically where we keep track of the passive losses. And if you're curious, you can just look up that form. It's an IRS Form 8852, and that's where everything is basically tracked. Yep, so 8852 is where the passive activity losses would be disallowed and carried forward, and that's basically your record of what's happening. Because remember, you might have more than one property, and all these properties are all going to net out and all going to carry forward into the future, depending on what you have with each property. And this Form 8852 with some sub-schedules would keep track of that. So if you've ever looked at your tax return and you just like skimmed through most of it, next time you might want to pay attention to Form 8852 and see what that looks like. Yeah, so as long as you have that active participation, so you're involved in management, you own more than 10% of this, you're not a limited partner, and this is your only property, things are quite straightforward, and you would actually be able to reduce your taxable income by this amount. And so now you just saved a whole bunch of money, right? So 75,000 is now being taxed as opposed to 100,000. So this is really great for most people because they just saved money. Now remember, what happens if the income goes up? This 25,000 starts to get reduced until it's wiped out, and people tend to fall into that pitfall. So you want to avoid that at all costs and try to get the most out of the tax system by just knowing what should be there or when you're going to be crossing into a higher income and what can potentially happen. So that way you're prepared and aren't going to experience a surprise tax liability by the time you get to filing. Okay, so that's pretty much as straightforward as it gets, right? So why don't we talk a little bit about what's the other situation? So I'm not just a regular renter and I have 30,000 in losses, but I am a real estate professional. So remember, real estate professional, also, by the way, for spouses, if one spouse is a real estate professional, kind of counts towards both. So that's the good part. And so here I'm very heavily involved as a real estate professional, and I need to deduct these losses, right? So if I want to deduct these losses, therefore I need to, and when I say losses, I want to get all 30,000 losses, not just 25, because remember, this is my bread and butter. I'm not just an investor. I basically am a real estate professional. So I might have many other properties. I might have, also a real estate agent's license or a broker's license. So I'm constantly involved in working in real estate. This is basically my living. So you can almost say this is my inventory in a way. And you can see why now it's being treated differently. It's because it's more of a business. And so if your business loses this kind of money, you probably can obtain all of this losses. If you're very involved and you put up money into this business, you would get all of the losses if all of the conditions are met, right? And so that's why the tax law looks at this way and says, wait a minute, well, you're not just a regular renter. You're not just a regular landlord that went out and is just doing a little bit of side investing. You are really a real estate professional, and this is really your business. So there's no reason why we should start capping you with $25,000 limits and $150,000 Maggie limitations and so on, just like any other business. Now, so what does it take to be considered a real estate professional? We already discussed that. You need the 750 hours. There's nothing else that really takes up more of your time. And when I say that, they can really look at everything. They can see like your hobbies. They can question what you're doing with your free time because they want to make sure that you're really involved in the profession. All right. And then you have, so first and foremost, to obtain all of your losses, you need to first be considered a real estate professional. And like I just said, you need to put in a bunch of hours, and this has to be your main line of work. And then you also need to materially participate. So back to materially participate. So material participation is a more stringent level of tests that you must meet in order to obtain full losses, right? So there's basically 7 tests, okay? And I'm going to quickly go through all of them and kind of explain what each one means the best that I can. And just know that the first 3 are really the ones that we really typically see people satisfying. The last 3 are typically not applicable because they're really set up for anti-abuse rules, if that makes sense. And I'll go over that in a minute. But why don't we see what it typically means to satisfy the first 4 tests. Okay, so the first test is basically you're working more than 500 hours per year on this activity. So that's as straightforward as it gets. Now, you do not need to keep a log per law, a contemporaneous log, as they say. Excuse me while I sip my coffee. Now, so where was I? Yeah, so you don't have to keep a contemporaneous log, but believe it or not, it's it's really advisable to do so. And there's a whole history behind this. And can you imagine people being forced to keep a log? People already have difficulties keeping contemporaneous logs. So they did away with that and they said, fine, you can just not keep it. But would it help? Yeah, it absolutely would help to keep track of what you do with your time. So greater than 500 hours per year. So that if you're a real estate professional and you're putting in over 750 hours, I think by default that this would qualify you. Substantially all participation. So anyway, you're participating substantially most of everything. And it can be as little as 6 hours, but you're basically doing all of that participation. So there's nobody else in the activity that's participating more than you, if that makes sense. All right, greater than 100 hours and not less than anybody else. So that just speaks for itself. So you're putting in over 100 hours, but it's not less than anyone else. I think that says it all. Greater than 100 hours with the aggregation of all such activities that fail all other material participation tests with aggregate hours of over 500. And I put hours in twice, which is fine. I think you understand what that means. So if you're going over 100 hours with aggregation of all such activities that fail all other materially participation tests with aggregate hours greater than 500. So that's very difficult to understand, and I don't really quite get it either. I'll be very straightforward with you. I guess it just means that if you have over 100 hours and you add everything up for all other activities, there's no other test that can be met and that exceeds over 500 hours. So it's worded incredibly awkward, and it doesn't make any sense to me. So I typically don't see that. Most people will satisfy the 500 hour per year and we're done. Or they go with 100 hours and not less than anyone else. That's typically what we see. Now, the other three tests all deal with anti-abuse rules. And anti-abuse rules is basically dealing with situations where people went out there and tried to like spin things a certain way. And that really deals more with business as opposed to real estate per se. And so let's look at this one. This is material participation in any of the 5 of the preceding 10 years using tests other than this one. So this is really geared for professional service firms that can manipulate the income stream, where you would have income one year and loss another. So in the years you have income, you say, hey, I did not materially participate. So great for me then. And then years you have losses, you say you materially participate to receive the losses. So you can see how this test kind of wants to look back at 5 out of the 10 years and see exactly how the material participation went, and not just say, let's look at 1 year versus another year versus a third year, because obviously people can say one thing 1 year and another thing another year, and all of a sudden, you know, the years that you need the losses, you're taking it, and the years that you don't want to get the income, then you're going the other way. So that's how that rule was created. And then let's see, material participation in any of the preceding years if a personal service activity. So if you're a CPA firm and a legal firm and then you retire, well, you no longer participate, but you're still receiving profit distributions. Well, if you're no longer materially participating, but you're still receiving the income, there are no losses. So someone can say now, I'm getting paid, but no longer working. So I can say this is passive income and shelter the income from tax, regular income tax, right? And so that's why they came up with these other rules. So again, and then lastly, regular, continuous, substantial involvement. They're very convoluted rules. And I think that the gist of it is that the last 3, like I said, won't apply to most people. But if you meet them, then great. You know, so let's say you don't fit any one of these 3, you might still fill in one of these. Okay. But that's rare. Usually people just fill in 1 or 2. And that's it. And then we're considered materially participating for the real estate professional exception. And then all your losses are freed up. All right, guys, I hope that this segment helped. Remember, our motto here at the office is your success is always our success, all day, every day. We want to see you guys succeed. So if you like the video content, we'd like to see your comments, your thoughts about the presentation overall. If we helped, if we didn't, if we made it more confusing for you, then let us know. Because tax law is confusing, and we're here just trying to make it as straightforward as we can for everybody to understand and benefit, because we believe in empowering our clients. The more they understand, the easier our jobs are, and the better off everybody is. It's already a convoluted system, so let's work together to make sure that we're getting the most out of the tax system legally possible. All right, guys, you guys all are wonderful. Thank you so much. Remember, like and subscribe. Hit that button to be notified of more videos coming soon. Thank you. Have a great day.